So you don't have to be an economist to tell something just isn't right with this economy. And I'm not talking about this woeful recovery that we've sort of muddled through. But more recently, it feels like this economy is really slumping. I mean, think about it. Christmas, we saw empty malls. There were more red shirt wearing salespeople in Apple stores than actual customers. And I didn't think it was possible, but a month ago, the notion that the nation was lurching toward a recession was sort of far-fetched, but now I think we're very close to that negative territory. Yesterday, the Atlanta Fed lowered its forecast for the fourth quarter GDP. In fact, since December 11th, the forecast has fallen precipitously. Just less than a month ago, they said we would grow at 2% last month. Check out, as these news items came out, more and more to yesterday, 0.07%. A series of disasters, one after another. We could be talking about a recession. It all depends probably on the Friday jobs report. So let's bring in our investment pros, David Nelson and Jim Frischling. Been a long time, guys. The band's all back together again. But what the audience wants to know is the market started off this year very sloppily. The world economy looks worse again. China obviously imploding. David, recession?
No, I don't think so. And the Atlanta Fed is not the only one cutting the numbers. J.P. Morgan went down to 1 from 2. That's a pretty big cut. But the one thing that's going to hold it up, the jobs market is still pretty strong. Job openings right now are at 5.4 million. You compare that to continuing claims down at 2.1. I think we're going to squeak through. I think it's sloppy, but we're going to be okay.
The problem, though, with that jobs report, and I know that's on Janet Yellen's so-called dashboard, is that quits haven't gone up. You know, there's something odd about that. When you got 5 million jobs, people usually say to their boss, take this job and shove it. I can get a better job with more salary. Now people are like, you know, they're not doing that. Like, there's something eerily wrong with that number.
Well, look, I'm gonna disagree with David, but I don't think we're actually so far apart, because I actually look, first of all, what's the definition of a recession? It's 2 consecutive quarters of negative growth. So it's 2 quarters negative growth, and we're talking about growth 0.7% according to the IMF, 2%. So we're not so robust right now. To your point about jobs, I think the unemployment situation is somewhat being it's better on paper, looks better on paper than the reality. So yes, unemployment below 6%, that's great. Wages flat, modest, but there's still a large part of this population that's underemployed. And given the dependence on GDP, on growth, on the consumer, we're putting a lot of pressure on the U.S. consumer, especially when we're the best-looking one of a pretty tough-looking group out there, considering what's going on in China and in Europe.
Well, who would save the economy then? I mean, it's not going to be the consumer. It's not going to be businesses. Who's going to build a factory in this environment? And without those two...
They have the money to build a factory. They're just not doing it.
They're buying back their stock.
They're buying back their stock. The next leg of the bull market is going to have to come from CapEx, and so far we're not seeing that. At some point in time, these people are going to have to invest. They're going to see their stock prices suffer.
David, Friday, the job number comes out. Let's say it's under 100,000. Let's say it's a dud. Would you be willing to say, okay, something is wrong? Would that be a red flag for you? Because I don't like the way it feels right now. Again, a month ago, I wouldn't have said
I think the market feels worse than the economy does. I think the consumer is okay, actually. They're just not spending it in the malls. They're spending it online. But
the market's supposed to be the leading indicator, or in terms of where.
It wasn't the leading indicator. You know, look, we had a robust market and a lousy economy. We might have, you know, an okay economy and a lousy market.
I mean, I just don't want to fight. I mean, we've had a 6-year, recovery, not a fantastic recovery. We've had a 6-year bull run. So again, by post-war standards, a recession really shouldn't be deemed to be.
I'm going to agree with you. The market is challenged, but the economy is going to muddle through. It's not going to be great, but we're going to be like maybe 2%.
I'm kind of opposite of you. I kind of think the market is masking serious pain on Main Street. I mean, it's been a flaccid recovery, and while we may not hit a recession, we can't afford any kind of bump in the road, I don't think.
You don't think that we could be just digesting the massive gains that we've had in the last 5 years?
Well, again, separating the market from Main Street, I'm just saying, I don't think Main Street has caught up to the point where the market it's up 180% from the lows.
Well, no, they never got the benefit.
Completely unloved rally.
The asset prices got it.
All right, guys, thanks a lot.